Welcome to the Central Florida Land Vlog. My name is Jason Toll. I'm with NAI RealVest. Today we're talking with Peter Hilera. Peter is a CPA. He's a partner with the Witham firm. We're talking about tax liabilities faced by long-term landowners when they go to sell their property. This is segment 3 of 3, and today in this segment we're talking about the tax liabilities from a 1031 exchange. So with that, I'd like for Peter to take it over, and thank you for watching. Let's come to the last scenario, and we're going to talk about a 1031 exchange. Most people know what a 1031 exchange, but not everyone knows what this is. Briefly, let's go into the basics of a 1031 exchange and what are the benefits of such a vehicle.
So the benefits is that you can defer the gain that you would realize if you straight out sold the property. So for example, you have a piece of land that 20 years ago you bought for $150,000. It's been sitting there vacant, and now that piece of land is worth $2 million. You have a substantial gain between the $150 and the $2 million you could sell it for. But let's say that at this moment, you're not ready, or you're not really ready to cash out. You don't need the cash and you like to defer the taxes on it. You can enter in an exchange where you sell that piece of property and you exchange it for a property that is equivalent in value or greater. And right now, 1031 can be any type of real property. So you can exchange land for a commercial building, for residential rental, anything that generates income.
You know, it's funny, the term is like-kind exchange, but really there's not a lot that's similar to let's say a piece of agricultural land and a residential investment property.
That is correct.
There's nothing similar, but yet it still qualifies.
That's right. Yeah, the real estate laws are very specific. And the real estate umbrella or the real property is very broad.
Right.
Years ago, the like-kind was very important because like-kind exchanges didn't only apply to real property, which is land, buildings, or any commercial property. It also applied to tangible assets. So you can exchange one plane for another or a car for another as long as it was held for business use. But of course, that went away several years ago, and now the like-kind, which as you say, doesn't really mean that the properties are like-kind, but the type of investment, real property, is under the like-kind umbrella.
Okay,
You're correct.
That makes sense. And what happens in a scenario where there's a 1031 exchange and the property owner, let's say, passes, and there's now a basis? What happens to the basis in that property? The gain that's been deferred. What happens to that?
Well, that's an interesting question. So let's take a scenario. For example, if that were to occur, when someone were to pass away and that person has that property in their hands, there's something called a step-up in basis, which means that deferred gain, which is deferred until you sell that replacement property, basically goes away, and you get a step up in basis, and you're able to now fully realize the cash out for it without incurring a significant gain.
So what you're saying is that deferred gain is no longer a liability.
That's right.
Wow. If that's not an estate plan, I don't know what is, right?
That's right.
Yeah, very interesting.